Elsa, nice to see you again.
Thank you, Jeff. Nice to be here.
All right, we're going to talk about REO and default properties and exactly what all that means. I've been here a long time, and I always forget what REO stands for.
Okay, well, I never do.
Good.
Real estate, REO stands for real estate owned.
All right, real estate owned. So then exactly what does REO mean?
Okay, so it's a financial industry term where the financial industries label the properties that they have taken back into foreclosure as real estate owned.
I got you.
So that's what they put on their balance sheets, that's what's on their books.
I see. So it is a term used by the financial industry or the banks, basically, right? The banks, mortgage companies, what have you.
Mortgage companies, mortgage servicers, the government, when they're talking to the banks and servicers, and the government entities like Fannie Mae, Freddie Mac, VA, talk about REO.
All right, so when we ask where do these properties come from, that's where they come from.
That's exactly right. So these properties are properties that are actually owned by financial institutions,
Gotcha.
or for those that were insured by a housing and urban development agency, taken back by HUD, or Fannie Mae and Freddie Mac guarantee. They don't actually insure, but they guarantee. And so real estate owned then, once they go through foreclosure, and if they're Fannie Mae or Freddie Mac guaranteed, go to Fannie Mae and Freddie Mac as REO.
Got it. Now, what is the difference then between REO property and default property? It sounds like it would almost be the same thing.
Exactly right. So in financial world, for banks and mortgage servicers and the government entities, foreclosure or default is the umbrella. And it includes everything from properties that are first delinquent. If they're 10 days, 15 days, where the borrower hasn't made the payment for whatever reason, they're then considered default. After a 30-day and that first month goes by and they're a whole payment behind, they're officially, a default property, or they're under that default umbrella. Then, of course, the more delinquent they become, the more they head toward that foreclosure situation, and then a few other levers happen.
Right.
A notice of default goes out from the financial institution or servicer to the borrower. They may have a short sale where they sell it short of full payoff. They might have a bankruptcy. They might have a deed in lieu. There are a lot of different facets of default properties, and the chronological as well as the legal terms of default.
Okay, so it just depends on how far behind you are getting in your payment, and that determines that chronological order.
It really does.
And then, so foreclosure auctions, then how do those come about?
So that is the actual mechanism when the financial institution has notified the borrower over and over and over. Maybe they've tried to work with them, help them refinance the property, help them sell the property, help them find a way to, the Home Affordable Refinance Program, HARP. You've heard about HARP. You've heard about HAMP, Home Affordable Modification Program. So the government has set up certain levers for the financial institutions and the borrowers to be able to come together and work together to try to get those properties either reinstituted where the borrower is able to pay, maybe reduce the interest rate, maybe do a forbearance where certain payments don't have to be made and are put at the end of the loan. Maybe some have reduced principal. They've tried to come up with a number of ways to help the borrower stay in the property. Or maybe the borrower tries to short sale the property. So with the financial institution's blessing, at the end of the day, they have to be able to say, yes, you can sell it for this, because of course most of that money still, was lent to that borrower by the financial institution. So they're the ones that say if a borrower owes $100,000, they want to say, yes, we understand the market value of that house is now $75,000. So we're going to let you sell it to a buyer for $75,000.
Right.
But that has to get approved by the financial institution before that transaction can take place. So then if none of those work, at the end of the day, it's going to a foreclosure auction.
Right.
That is a big emphasis today. The Housing and Urban Development, HUD, has developed a new program called the Claims Without Conveyance of Title program. And that is a program in which typically when you go to foreclosure auction, there's what's known as a credit bid. And the mortgage company or the bank instruct their foreclosure attorney or their trustee, depending on the state you're in. All of these legalities differ by state.
Right.
Everything is by state statute. So whether a foreclosure attorney or a trustee is handling that foreclosure auction, they give them what's known as a credit bid. The credit bid is the amount that that servicer would bid on behalf of the mortgage entity.
All right, gotcha.
So in HUD's case, HUD is insuring those loans. So for any financial institution that services HUD-insured loans, HUD is instructing them in a new program called the CWCOT. You know, the government likes acronyms.
Yes,
it means Claims Without Conveyance of Title.
Well, I'm glad you know what that means because I had no idea what all those letters stood for.
Which means they can file a claim, but they're hoping they will sell the property to a third-party buyer at the foreclosure auction rather than not, than having to take it back themselves if it doesn't sell. And the way they're making that happen today is the mortgage servicer, rather than bidding the total debt, rather than instructing their attorney or their trustee to bid the total debt owed, which means the amount that's delinquent, plus all of the fees, plus all the attorney's costs. That's typically what they would bid at a foreclosure auction. In past days. Now they've said you can get a current FHA appraisal, can't be more than 120 days old, and then they give specific quote-unquote haircuts or adjustments to take off the top of that foreclosure, that current HUD appraisal, and that is then known as another acronym, their CAFMV, Commissioner's Adjusted Fair Market Value. Well, in some cases, it could be 30% right off of that appraisal. So say that the current, maybe the total debt amount owed is $125,000, just to make up a scenario. But maybe the current appraisal is $100,000. The market has gone down in that area.
Right.
But the adjusted value, they can take 30% off the $100,000, which is now $70,000.
Right.
So you see what a great opportunity that is for buyers to buy at the foreclosure auction.
Sure, absolutely. So then that's how these become a bargain, especially for the investors out there who are looking to purchase properties that have gone into default or foreclosure or what have you. This is a heck of an education. Thank you.
You're welcome.
Very interesting. I'm going to have to go back and watch this interview again because there's so much good information there. You may not have caught it the first time. Elsa Lewis, thank you for joining us.
Thank you, Jeff. Thank you.
Executive Vice President at Williams & Williams, Elsa Lewis. We'll have more for you coming up right here at Auction Network Live.